You don't lose money because the market crashes. You lose money because you don't understand what's really happening. George Soros once said, "Markets don't reflect reality, they create reality." And that's exactly why millions of people will panic and lose everything, while a small minority quietly becomes wealthy. In the next 12 to 18 months, a massive transfer of wealth is taking shape, not because of luck, not because they're smarter, but because they see what the majority never will. They understand one dangerous truth. The false beliefs of the crowd are the opportunities of the few. Do you believe home prices always go up? Do you think the market will just return to normal? Do you believe working hard alone is enough to become rich? That's not reality. That's a collective illusion, and it's controlling your financial life every single day. In this video, we're not talking about get-rich-quick tips. We're going deep into the mindset of George Soros, how he sees markets as systems of illusion, reflexivity, and repeated mistakes. And more importantly, you'll uncover 5 financial decisions that seem harmless, but are quietly pushing you toward failure. The question is not if a crisis is coming. The real question is, when it does, will you be the one swept away or the one who's already in position to take advantage of it? Before we show you exactly what they are, hit that subscribe button. Now, what you're about to learn could be the difference between financial survival and financial destruction. You're not buying a new car in America. You're quietly signing a contract that weakens your financial future. That might sound extreme, but if you look at money the way George Soros does, it makes perfect sense. Soros never asks, "Do I like this?" He asks one question: does this decision make me stronger or weaker when opportunity shows up? And in a system like the US, where almost everything can be financed, a brand new car is usually a decision that makes you weaker. Think about how the process actually works. You walk into a dealership. They don't ask if you can afford the car. They ask how much you want to pay per month. $500, $700, even $1,000 a month. Be honest with yourself. If someone only told you the monthly number, would you still question the total cost? It sounds manageable until you realize you just committed to 5 to 7 years of payments on something that starts losing value the moment you drive it off the lot. The car goes down in value fast, but your debt doesn't. That's how millions of Americans end up underwater, owing more than the car is worth. But the real danger isn't just the numbers. It's the psychology behind it. In George Soros' idea of reflexivity, your actions create feedback loops. You buy a new car and feel successful. Feeling successful makes you spend more. Spending more kills your ability to build capital. And when a real opportunity shows up in the market, you don't have the money to act. That's how people miss life-changing moments. Now think about George Soros when he was starting out. He had no car, no wealth. At one point, he even had to borrow money just to get by. But he had discipline. He didn't spend money to look successful. He saved and waited for the right opportunity. And when that opportunity came in 1992, he was ready. One trade, over $1 billion in profit. Now ask yourself this: if he had been spending money on expensive cars, trying to impress people, living beyond his means, would he have had the capital to make that move? Or would he have missed it like most people do? Now let's bring this back to real life in America. Someone makes $60,000 a year. They buy a $50,000 car. Monthly payment, around $800. Insurance, maybe $200. Gas and maintenance, another few hundred. That's over $1,300 a month. Going into something that doesn't produce income. No investing. no flexibility, no margin for opportunity. From the outside, it looks like success, but financially, they're stuck. If you think like George Soros, the question is simple. Does this decision increase or reduce my ability to act in the future? A new car doesn't generate cash. It doesn't create leverage. It locks up your money. People who understand the game do the opposite. They buy used. They keep costs low. They build capital because they understand something most people ignore. In America, opportunities always show up during crises, but only for people who have cash and flexibility. The car you drive today doesn't matter. What matters is whether you're financially strong when everyone else is forced to sell. Next, we're going into a mistake that almost every American family believes is smart, but is actually one of the biggest financial traps in the system. And in the next few minutes, you'll understand something that took many people years to learn. In America, almost everyone grows up believing one thing. Buying a house is the smartest financial decision you can make. But if you look at it through the lens of George Soros, that belief can become one of the most dangerous financial traps. Because Soros doesn't look at assets the way most people do. He separates one simple truth. Does this put money into your pocket or take money out of it? And for most Americans, their home is not an asset. It's a long-term financial obligation that drains cash every single month. Mortgage payments, property taxes, insurance, maintenance, repairs. The bigger the house, the bigger the outflow. But here's where it gets dangerous. In the U.S., banks don't tell you what you should buy. They tell you the maximum they're willing to lend. And most people make the same mistake. They treat that number like a recommendation. If the bank approves you for a $600,000 house, you buy a $600,000 house. Let me ask you this. If the bank approved you for more than you expected, would you see it as a warning or an opportunity? From a George Soros perspective, this is where reflexivity kicks in. Rising home prices make people feel wealthier. Feeling wealthier makes them borrow more. More borrowing pushes prices even higher. That feedback loop creates the illusion that housing is always a safe investment, until it isn't. We've seen this before. During the 2008 financial crisis, millions of Americans believed housing prices could never fall. They leveraged themselves to the maximum. Adjustable rate mortgages, minimal down payments. Then the cycle turned. Home values dropped 30 to 40% in many areas. People owed more than their homes were worth. Foreclosures exploded. The system didn't break because people were irrational. It broke because they were following what felt normal. That's exactly how financial bubbles work. And today, the conditions are starting to look familiar. Interest rates are higher than they've been in years. Monthly payments have doubled for the same home price. Household debt remains elevated. Yet people are still stretching to buy at the edge of their capacity. From a Soros perspective, this is not just risky, it's predictable. Because when a debt cycle reaches its later stages, three things always happen: pressure, reversal, and forced selling. And the people who get hurt the most are the ones with the least flexibility. Let's make this real. A family earns $100,000 a year. They're approved for a $700,000 mortgage. They buy it. Their monthly housing cost is now $4,000 or more. That's nearly half their income. What happens if rates stay high, a job is lost, unexpected expenses show up? They don't have room to breathe. They don't have capital. They don't have options. They are locked into the system. Now compare that to how George Soros would think. He wouldn't ask, what's the biggest house I can afford? He would ask, how do I stay flexible enough to act when the cycle turns? Because in every major cycle, the biggest opportunities come when other people are forced to sell, not when everyone feels comfortable. The alternative strategy is simple, but uncomfortable. Buy less house than you can afford, not what the bank approves, not what society expects, something that keeps your monthly costs low and your financial flexibility high. Because every extra dollar you don't lock into a house is a dollar you can invest, a dollar that compounds, a dollar that gives you options, and options are everything in a crisis. There's a reason some of the wealthiest investors in the world don't tie up all their capital in personal housing. Even Warren Buffett has lived in the same modest home for decades, not because he can't afford more, but because he understands opportunity cost. Money tied up in a non-productive asset is money that can't work for you elsewhere. This is the core idea. In America, it's easy to confuse ownership with wealth, but they are not the same thing. Real wealth is not about what you live in. It's about what you control when the system starts to shift, because when the next downturn hits, the over-leveraged will be forced to sell, and the disciplined will be ready to buy. In the next part, we're going into something that seems small, almost harmless, but over time it quietly destroys more wealth than most people ever realize. There's something different about how young people in America spend money today. It's no longer just about living well. It's about being seen living well. New outfits for every event, the latest iPhone every year, designer brands, sneakers, tech upgrades, photos, posts, and a lifestyle that looks perfect from the outside. But if you look at this through the thinking of George Soros, you start to see the hidden pattern. You're not just making choices, you're reacting to a system that constantly makes you feel like you're not enough. Soros believed that perception drives behavior, and behavior reshapes reality. Today, social media amplifies that effect to a level we've never seen before. You scroll and you see people your age traveling, upgrading, buying, living better. You don't see their debt. You don't see their stress. You only see the highlight. So you respond. You spend to keep up. You upgrade to stay relevant. You buy to feel like you belong. And without realizing it, you enter a loop. You spend, you feel better temporarily. You compare again. You spend more. That's reflexivity, not in markets, but in your personal life. And what happens next might surprise you. Now let's make it real. A 5-year-old earning $70,000 a year. They upgrade their phone regularly, spending around $1,000 each time. They spend $200 to $300 a month on clothes and appearance, another $100 to $200 on gadgets, trends, and small lifestyle upgrades. That's $4,000 to $6,000 a year, not invested, not compounding, just consumed. But the real cost is deeper than the money, because over time, you start building your identity around what you own. And once that happens, you're no longer choosing freely. You're maintaining an image. According to George Soros, when perception takes control, reality gets distorted. You start telling yourself things like, I need this to feel confident. I deserve this upgrade. Everyone else is doing it. But those thoughts are not neutral. They are shaped by pressure. And pressure leads to bad financial decisions. Look at the tools available today. Buy now, pay later. Credit cards everywhere. One-click purchases. Influencers normalizing constant upgrades. You don't even need money to spend anymore. You just need access. And that's the danger. Because you can build a lifestyle that looks expensive without ever building real wealth behind it. From the outside, everything looks polished. But underneath, there's no foundation. If you think like George Soros, the question changes. It's no longer, does this look good? It becomes, does this make me stronger financially? Clothes don't generate income. Phones don't compound. Trends don't create opportunity. They create emotion, short-term satisfaction, and long-term cost. The deeper issue is comparison. There will always be someone ahead of you. Better dressed, better tech, better lifestyle. If your decisions are driven by that comparison, you will always feel behind. And more importantly, you will stay behind. The alternative is simple but uncomfortable. You stop buying for attention. You start buying for function. You keep things longer. You upgrade less. You ignore trends that don't serve your goals because you understand something most people miss. Every dollar spent on image is a dollar not working for your future. And over time, that difference becomes life-changing. In America, it's easier than ever to look rich. But real wealth has nothing to do with appearance. It's about control. Control over your time, your decisions, your future. And that control comes from capital. When the cycle turns, and it always does, people who spent years maintaining an image will have nothing to fall back on. But those who ignored the noise, who built quietly, who invested instead of performing, they will be ready. Next, we're going into something even more subtle because it feels small, automatic, and harmless. But over time, it quietly drains more money than most people ever realize. Stay with me, because the next part explains why most people never escape this cycle. There's a type of spending that almost no one feels. You don't remember signing up. You don't notice the charge. You don't question the value. But every single month, it takes money from you. Subscriptions. This is one of the most dangerous financial leaks in modern America. Not because it's large, but because it's invisible. And if you look at it through the thinking of George Soros, it becomes very clear what's happening. You're not just losing money, you're being conditioned into passive financial behavior. Soros believed that systems shape behavior, and behavior repeated over time shapes outcomes. Subscriptions are designed to remove friction. One click to sign up, zero effort to continue paying. And that's where the problem begins. Because when there is no friction, there is no awareness. Now let's look at what this actually looks like in the U.S. A typical young professional might have Netflix, $15 a month, Spotify, $11 a month, Apple iCloud storage, $3 to $10, gym membership, $50 to $100, Amazon Prime, about $15, a couple of app subscriptions, maybe $10 to $20 total, meal kit services like HelloFresh, $60 to $100 a week, even if rarely used. Individually, none of these feel significant, but together they add up fast. $200, $300, sometimes $400 a month. That's $3,000 to $5,000 a year. Leaving your account quietly, no decision, no reflection, no resistance, just automatic loss. And here's the deeper issue. According to George Soros, when people stop actively making decisions, they lose control of outcomes. Subscriptions create that exact environment. You are no longer choosing how to spend money. The system is choosing for you. Now let's take a real example. Someone signs up for a gym in January. They go for 2 weeks. Then they stop. But the $75 monthly charge continues for the next 12 months. That's $900 for something they didn't use. Add 4 streaming services, but they only watch one regularly. Another $40 to $60 a month wasted. Add a few forgotten app subscriptions. Another $20 to $30. Suddenly, They're losing over $150 every month on things that provide little to no value, and they don't even notice. This is how money disappears in modern America. Not through one big mistake, but through hundreds of small, ignored ones. And over time, it becomes massive. $300 a month invested instead of spent, over 30 years at a reasonable return, becomes hundreds of thousands of dollars. That's the real cost of convenience, not the monthly fee, the lost future. Now think like George Soros. The question is not, is this cheap? The question is this making me stronger financially? A subscription you don't use is not neutral. It's negative. It reduces your capital. It reduces your flexibility. It reduces your ability to act when it matters. And most importantly, it trains you to ignore your own money. That's the most dangerous part, because once you stop paying attention, you lose control. The alternative is simple, but requires discipline. You review your subscriptions regularly. You cancel anything you haven't used in the last 30 to 60 days. You question every recurring charge. You bring friction back into your financial life, because friction creates awareness, and awareness creates control. In a system designed to take money from you quietly, attention becomes your advantage. In America today, it's not the big expenses that destroy wealth. It's the small ones you stop noticing. And when the cycle turns, those small leaks will determine who has capital and who doesn't. Because in the end, wealth is not just about how much you make, it's about how much you keep and how well you position yourself for what comes next. This is where everything comes together. Most people think financial failure comes from one big mistake, a bad investment, a market crash, a moment of bad luck. But that's not how it actually works. If you look at money the way George Soros does, you start to see a different pattern. Wealth is not destroyed in one moment. It's slowly weakened by small, repeated decisions. The expensive car that locks up your cash, the oversized house that drains your income, the lifestyle spending that keeps you chasing an image, the subscriptions that quietly leak money every month. Individually, they feel harmless. Together, they create fragility. And fragility is what breaks people when the system shifts. Because when a real opportunity appears, most people aren't ready. Not because they're not smart, not because they don't work hard, but because their money is already committed, locked, spent, gone. That's the part most people never see. According to George Soros, the biggest opportunities don't come when things feel safe. They come when the system is under stress, when others are forced to sell, when fear takes over the majority, and in those moments, only one thing matters. Do you have the capital and the clarity to act? So, here's the real takeaway. It's not about avoiding every mistake. It's about building a position of strength, lower fixed costs, higher flexibility, more control over your capital. Because in the end, wealth is not about how impressive your life looks today. It's about how prepared you are when everything changes. So ask yourself one final question. When the next shift happens, will you be reacting like everyone else? Or will you be ready while others hesitate? Because that single difference is what separates the majority from the few who quietly win. Thank you for listening.